Let's get across the market open now. Jimmy Jang joining us from GBA Capital. Jimmy, welcome back to you. Now, of course, we saw a dramatic sell-off on Friday on global markets. That flowed in through to Asian markets yesterday. Perhaps thankfully, the Australian market, we had a holiday. So what did you make of what we've seen just over the past 48 hours or so?
Morning, Andrew. I think the immediate trigger of that sell-off in the US was a combination of, the stronger than expected US economic data, and obviously a lot of the profit-taking pressure that we're seeing in the semiconductor industry. So investors have been kind of anticipating interest rate cuts from the Fed, but obviously with the recent employment data, it all kind of really points towards that the US economy remains resilient and obviously reducing that expectation of that near-term rate cuts as well. And as a consequence, we kind of saw that flowing into the treasury yields obviously moving higher and the US dollar strengthening. So investors are really kind of beginning to reduce their exposure to risk assets. So a lot of the tech and the semiconductor stocks, which had that led the rally this year, became their primary targets for profit taking. So that's obviously is one of the main reasons why we're seeing, for example, Nvidia pulling back, while Jensen Huang is in Korea right now, strengthening his partnership with the Korean semiconductor companies like Samsung, SK Hynix, and Hyundai, which is their global partner for robotics, is obviously causing a rapid adjustment in positioning that kind of spilled into the global markets at the moment.
So, what would your expectation be in Asian markets today then, given what we've seen? And I guess more broadly, Jimmy, at a macro level, are you seeing some concerns there that will prompt investors to take a bit of a rethink?
Yeah, look, obviously the key word that investors are using at the moment is circuit breaker, right? Obviously that kind of grabbed a lot of the headlines, and it is a frightening signal for the investors. However, my view, the circuit breaker is more than a safety mechanism rather than a signal for market failure. So obviously, one of the main things that we need to really look at is, just because we see a sharp sell-off in a lot of the broad equities, that's not really a signal for a market failure. It could be a very healthy correction that we might see in the market. One of the main things that investors should be really, closely look for, other than just the share price, is the main two key indicators with the market pulling back. So U.S. interest rate is it can't be anywhere more clearer as to whether this sell-off is a momentary or something that's going to prolong longer. So if we see a sharper, interest treasury yield, rising, that obviously puts a huge risk on pressure on risk assets, especially in the tech and semiconductor. And at this level, obviously, it's a lot more higher than what it used to be. It doesn't mean that it's a new kind of norm that we're living in at the moment. So if we're pushing, let's say, close to 6% yield, then that could be another huge alarm that the investors should be taking risk off the table immediately. But it's not something that we're seeing at the moment. And US dollar, another one is obviously the main thing. Stronger dollar obviously tends to tightening up the global financial conditions. So obviously can create headwinds for the emerging markets like the semiconductors and AI at the moment. But in terms of Asia, I think if we look at Samsung, for example, in Korean index, they had the biggest rally of this year, and it's not even half of the year completed yet. So just because we see a 10% pullback in the Korean and the Asian market, that doesn't mean that it's a start of a crisis. I think that's more of a correction in my view. When our index itself runs about 50 to 60% in less than half of the year, we have to expect a correction at some point. So 5 to 10% pullback is not. I wouldn't say that's a start of the crisis, Andrew.
Yeah, as you point out though, Jimmy, given how far those stocks have run and more broadly, I mean, we've seen that in Korea, Japan, obviously on Wall Street. You say a correction is due. You could say that it's healthy, but you don't necessarily see the latest events as a catalyst then.
No, not at the moment. And look, we just this morning before we walked into our office, we saw the OpenAI, for example, announcing that they have confidentially filed for an IPO, and we also have SpaceX IPO coming to the market very soon. So I think there's enough excitement in the market to at least keep the excitement within the market. I think one of the main thing we need to really look for is when is this war in Iran going to really finish? And Trump government has no real kind of choice but to put this to an end pretty soon because they have their midterm election coming ahead very soon as well. But look, in terms of if we look at the previous market, for example, one of the most consistent patterns in financial markets is that every major decline feels unique while it's happening. So during the dot-com crash, we saw the GFC and obviously the European debt crisis and also the most recently pandemic in 2019 to 2020. Investors repeatedly believed that the situation was fundamentally different. But over time, markets always return to the same question, which is how healthy is the economy and how strong are the corporate earnings and how effective are the policy responses. And we're seeing the Walsh, who is going to be the new, chair of the Federal Reserve, also making some, should be making good decisions for the financial market. So those fundamentals ultimately determine whether a sell-off becomes a temporary correction or a prolonged bear market. And in my view, it's more pointing towards temporary correction in my view.
So, Jimmy, just focusing on the local market, we have seen a bit of a rotation out of, well, particularly the banks, materials into what has been termed the dogs of the index, in particular healthcare stocks. What are you seeing there at the moment?
Yeah, look, it's a good question. Right now it's really tough to kind of, determine, whether we want to really, put anything into the market just because the volatility is so high. But, we are seeing some, good results, like for example, CSL, we want to say the directors putting close to about $100,000 accumulating their position in market this week, last week. So we saw a bit of a jump in the healthcare space. But at the moment, it's right now, I think the best thing to do is to just really reevaluate whether you're comfortable in holding on to your existing holdings rather than trying to find a new opportunity. Because, even though we might see a non-cyclical sectors like CSL and healthcare should fundamentally do better when, in a market of volatility like this. But at the same time, the reason why, one of the key drivers that's really driving the market sell-off is not really fundamental basis. It's largely with the price of oil, stronger US dollar, and what the, monetary policy will be like, in the next coming weeks by the Federal Reserve with the new chair as well. So, what we really like at the moment is cash. You got to accumulate cash. If there is profit that you can take to accumulate cash, that's one of the reasons why we're seeing a big sell-off in the market as well, because of a lot of people accumulating cash with their, semiconductors, tech, and especially recently, a lot of the critical minerals have also ran in Australia as well. So, cash is going to be the king, more and more so, because if we do see any kind of sudden changes by the Federal Reserve in the US, potentially could be a rate hike. Obviously very small chance of that happening. But if there is any kind of, indicator that we might see a rate hike anytime soon in the minutes, then the market will sell off. So we need to be able to, pick up those stocks at a lot more discounted price. So cash is something that I really strongly recommend to accumulate at this point. And then, we probably will see some better opportunity to allocate new position into portfolio.